Equity shares. Definition, meaning, types, risk and rewards. Meissen GKB. December 3, 2023. 1. Ownership and residual claims. Equity shareholders are a company's remaining owners. This implies that after all debts and other commitments have been settled, they are entitled to a share of the company's assets and profits. Through dividends and capital growth, they share in the company's prosperity. 1. Ownership and residual claims. 2. Voting rights. Normally, equity shareholders are entitled to vote on significant business issues, including the election of the board of directors and significant business choices. A shareholder's vote count is typically inversely correlated with the number of shares they own. 2. Voting rights. 3. Dividends. Company may pay dividends to their shareholders from a percentage of their profits. Nonetheless, the company's board of directors has the last say over dividend payments. After all debt holders and preferred shareholders' obligations have been satisfied, dividends on equity shares are distributed. 3. Dividends. 4. Risk and reward. Compared to debt products like bonds or debentures, equity shares are riskier. They do, however, also present the possibility of increased returns due to capital growth. When the business does well, the value of the shares rises, which benefits the shareholders. 4. Risk and reward. 5. Market value and liquidity. The market uses supply and demand to determine the value of stock shares. Economic trends, industry conditions, and the company's financial success are some of the elements that affect it. Because they may be purchased and sold on the stock market, equity shares are typically more liquid than some other types of investments. 5. Market value and liquidity. 6. Preemptive rights. Preemption is a legal right that gives equity stockholders the opportunity to buy more shares before they are made available to the general public. By doing this, current shareholders are able to retain onto their proportionate ownership. 6. Preemptive rights. 7. Types of equity shares. 7. Types of equity shares. Common shares, usually accompanied by voting rights. These constitute the most basic type of equity ownership in a firm. Preferred shares. Preferred shares are a form of ownership even if they are not common equity. In contrast to common shares, they could have separate voting rights and typically have fixed dividends. 8. Reporting and accounting. Under shareholders' equity on the balance sheet, equity shares are listed. All equity share-related activities, including issuances and repurchases, are noted in the company's books of accounts. 8. Reporting and accounting. 9. Share capital. A company's share capital, or the entire value of its issued shares, is derived from its equity shares. A crucial part of the company's overall capital structure is the share capital. When thinking about purchasing equity shares, investors should learn as much as they can about the performance, financial standing, and prospects of the business. Equity share values are subject to market changes, thus investors should be ready for such events. Businesses can raise money for a variety of reasons, including expansion, R&D, or debt repayment, by issuing equity shares. 9. Share capital. 10. Recording of shares transactions. A. Issuance of shares. The following entries are made whenever a business offers new shares, whether it's through an IPO or a follow-up offering. A. Issuance of shares. Debit, cash or bank, for the amount received from the share issuance. Credit, share capital, for the par value of the shares issued. Credit, share premium, for any amount received above the par value, if applicable. B. Repurchase of shares, treasury stock, when a business buys back its own shares. The following transactions are noted in the books. B. Repurchase of shares, treasury stock. Debit, treasury stock, an account within shareholders' equity representing the company's own shares. Credit, cash or bank, for the amount paid to repurchase the shares. C. Issuance of treasury stock. The following entries are made when the corporation reissues its treasury stock. C. Issuance of treasury stock. Debit, cash or bank, for the amount received from reissuing the shares. Credit, treasury stock, to reduce the balance of treasury stock. Credit, share capital, for the par value of the reissued shares. Credit, share premium, for any amount received above the par value, if applicable. D. Dividends paid in shares. In the event that the business pays out extra shares as dividends, the entries are: D. Dividends paid in shares. Debit, retained earnings, for the amount of the dividend. Credit, share capital, for the par value of the shares issued as dividends. Credit, share premium, for any amount received above the par value, if applicable. E. Stock splits or reverse stock splits. Reverse stock splits and stock splits include reducing the number of shares that are outstanding without lowering the company's overall worth. The entries vary according to the type of split, but they usually entail changing the par value and the number of shares. E. Stock splits or reverse stock splits. F. Adjustment for stock options or warrants. The number of shares may change if the corporation grants warrants or options for stock, depending on when those rights are exercised. The terms of the warrants or options govern the entries. F. Adjustment for stock options or warrants. G. Share-based compensation. Accounting entries are made to reflect the cost if the company gives shares to staff members or other service providers as part of their pay. A share-based compensation reserve may be established as a result of the entries. G. Share-based compensation. Additional considerations. Depending on the company's accounting policies and chart of accounts, different accounts may be used. When recording share transactions, businesses must adhere to accounting rules like Generally Accepted Accounting Principles, GAAP, or International Financial Reporting Rules, IFRS. For the sake of transparency, businesses frequently include information about their share transactions in the notes to the financial statements. Additional considerations. To guarantee accurate financial reporting, the company must record share transactions in accordance with accepted accounting practices. The company must also abide by the rules of the applicable stock exchange if it is publicly traded. To handle the complexities of share transactions and keep correct financial records, it is advised that company collaborate with accounting specialists. Labels. Advantages of equity shares. Common shares. Disadvantage of equity shares. Dividends. Equity shares. Issuance of shares. Preferred shares. Share capital. Stock splits. Treasury stock. Types of equity.